Hello, in this presentation we will purchase equipment by financing that equipment with debt, taking out a loan within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are with the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be purchasing equipment, but we will be purchasing it not with cash, but with debt. This seems like an easy transaction, but it can be a little bit tricky because we can't use the normal tools we used in order to purchase something. For example, if we go up top and take a look at our normal tools, we could say we're going to purchase something typically from a vendor. And if we go through these, we can say, well, maybe we can use something like an expense to do it. But really, we're not buying an expense. We're buying a long-term thing. We're buying equipment that's going to last for a long amount of time. So it's not quite right to do the expense. We can't write a check because we're not going to write a check. We're not writing any check, so we're not going to use that. A bill, it seems reasonable. We could use a bill, but if we do that, it's going to put that into not really a loan account, but into accounts payable. And those are going to be two different things. The accounts payable account typically is going to be a more short-term thing, something due within 30 to 60 days max, whereas a loan is something that we typically sign a formal agreement for. We're going to charge interest on. Usually the amount is going to be larger, and we're going to have some kind of payments that we'll have to be making on it. So we really don't want the bill because it's going to put it, while it puts it into a liability, it's not really the right one that we want. We want to put it into a loan payable. Then it's not going to be the pay bill. Purchase order doesn't have any transactions related to it. That's related to inventory. So there's nothing here really to have this transaction take place. We're going to purchase something, a large piece of equipment, like a forklift, let's say, or something like that. It looks like furniture here. And then we are going to finance it. So we could do, normally most accounts probably would jump over to the journal entry and create a journal entry. If we look at that screen though, if we go to the journal entry screen, what we have here are debits and credits. Now if you know debits and credits, this is probably the most easy place to enter this information. But if you don't, and there's only two accounts, so it's not too bad even if you don't know debits and credits well. But if you don't know debits and credits, it could be a little difficult. So if you know debits and credits, this is probably where you would want to go for this, the journal entry type transaction. Debiting what we're going to have this case, which will be the equipment account, the furniture and equipment, and then crediting we're going to have loan account, which will increase the loan payable. We're going to try to do it a different way just because we're going to be inputting this where we're going to limit the amount of debits and credits we know. If you know debits and credits, it actually makes it a lot easier a lot of ways because you can use a lot of reports in a more efficient way. But we're gonna try to put it in the other way. And just because we're not using debits and credits, by the way, doesn't mean that debits and credits aren't helpful and they're not going to help you as you look through this stuff. Some of the most important reports or easiest reports to look at will be the trial balance, and that's going to be in the format of a debit and credit. And if you look at these running balances, they're really using kind of a debit and credit type of structure. But a lot of data input, we try to limit the debit and credit so that the input will be as easy as possible. The reason there's not a real form to do this data input is because it's an unusual transaction. Not in that it never happens like ever or in any company, like companies buy equipment all the time, but it doesn't happen every day, in other words. So unlike an invoice where we make sales every day or we pay bills all the time, therefore there's no form that's really set up just for this item. It's also going to be somewhat individualized in that the type of equipment we purchase is going to differ because there were large purchases of different items, and the loan terms could be different as well. So that's one of the reasons there's not a form. That's one of the reasons when that happens, when we have these types of transactions that don't happen all the time, that's when we have to know a little bit more in order to enter that information and see what's going on with it. Now, another way we can try to enter this is to use the registers. So that's what we're going to do here. We're going to go to the accounting on the left side. And if we look through our registers, the checking account is the first register. That's the one most familiar to most people, the register format. But we have a register for every balance sheet account. And the two accounts we're dealing with will be the furniture and fixture account and the loan account. So we could use either of those. And it's again, it's a little bit more unusual to do this. Like if you know debits and credits, it's probably the easiest way to go. But we can do this here. We could say, okay, this is the furniture and fixture account, and if I look at the register, I can say, well, it needs to go up because we bought more furniture and fixture. And then I'm just going to select the other side, the loan, in this register and tell QuickBooks, hey, do whatever you got to do to the other side to make this happen. So let's see how that works. We're going to select this register. So remember, this is not the check register. This is going to be the register for the furniture and fixture, which is an asset type of an account. What we will do here is we will add a transaction. So we're going to go up top and we're going to select this drop down. Note there's not too many options, of course, for the transactions because this is something that really the only transaction that you're going to use in order to affect this register is typically going to be a journal entry. But the journal entry screen will look a little bit different. It won't have the debits and credits, but plus and minuses. So we'll see that. We'll go to the journal entry. And here is our journal entry. It looks a lot like a check register, as if we're entering a check into a register on the checkbook. But this is going to be not the checking account, but the loan account. I mean the furniture and fixtures account, an asset account. So the date's going to be 02/28/21, February 28th, 2021, the end of the month. We're going to say reference. I'll keep the reference to. It's an automatically generated reference. We're going to say that the payee is going to be Office Depot. We're purchasing from Office Depot. However, we're not paying any cash. We're financing it. We're financing the whole thing with a loan, not accounts payable, not a short-term finance, but a long-term finance, paying interest on it and whatnot. I'm not going to put the memo here, and we're going to say it's going to be an increase. Now, it's going to increase, meaning we're in the asset account of furniture and fixture. That's the account that will increase. The cost is going to be $5,000. That's how much we're purchasing it for. Also, the loan amount. We're not going to pay anything for it, so the other account is all going to go into the liability, not accounts payable, but loans payable. So we could find that in the drop down. It's guessing it's going to be an expense, but it's not. It's going to be a liability. I'm going to start typing it in there, loan payable. There's the loan payable, and we'll select that item. And there is it. So we're going to save that, and we want to make sure to click that save and make sure it's on a separate line item before we move forward, or else it may not save, obviously, if we don't do that. So you want to make sure we're off the line, we've hit the save item, and it's on a separate line. Now we're going to check out what has happened in terms of the financial statements. What we expect to happen, of course, is that this being the register for the furniture and fixtures, it should go up by $5,000, that asset account. The other side's a loan. It's not an income statement account. Nothing's happened to revenue or expenses. The loan is going up, and that's going to be the loan payable liability account. So let's take a look at that. We're going to go to reports on the left side. We're going to go to the balance sheet, and we'll take a look at the dates. Will be 02/01/21 to 02/28/21. February 1st, 2021 to February 28th, 2021, and run that report. So here is our report. If we scroll down through the report, we then see our information. I'm going to scroll to the assets first. In the fixed assets, we have furniture and fixture. Now we're breaking out here between the original amount, this was what was put in for the opening balance when we first started the company, versus the activity. So furniture and fixture here, and that'll total up to this $103,000. We're going to select the $28,000 here, the furniture and fixtures, and that'll give us our activity. So we had $23,000 before this. Here is that $5,000 that we just entered, bringing the balance to $28,000. If we select that $5,000, then we're going to see a journal entry. And note this is that journal entry screen. It's not going back to the register format that we saw before, but we entered within that register format basically a journal entry. And again, QuickBooks trying to say, hey, we're going to try to let you, put up an area we don't need to know the debits and credits as we have here in order to enter that information. But really, this is going to be a journal entry format. There's no form that we can go to that's standardized. It's really just got to be a journal entry that's going to be entered into this format because it is an unusual transaction or one that doesn't occur on a daily basis. So we're going to close this back out. We're going to take a look at the other side. So we'll scroll back up to the top. We're going to go back to our report summary. And then the other side is going to go into the loan. So if we scroll down, we took out another loan here. So we've got the loan payable. If we select the loan payable and scroll down, we see this $5,000 there. So it's increased in the loan. It was at $70,941 before that. Then we have this bringing the amount up to $75,941. And note we have these payments that are a bit out of order because we made these payments to show at the beginning of this problem, a payment at the beginning of a loan, and then the payment at the end of the loan. So in essence, we're grouping another loan. And note this is a different loan than we started with. This isn't all the same loan. We're putting it all in the same loan account, and then we're going to have to make adjustments at the end of the month to break out one, whether they are, if we want to break out two loans, but we'll keep them into one section saying loan payable, but we want to break out the short-term portion of it. And this loan may be all short-term, and therefore the whole thing should probably be broken out and put in the short-term portion, meaning it's going to be due within a year. Anything due with over a year should be in the long-term portion of loan payable. We'll address those issues as we go to the adjusting entries. So let's take a look at that loan payable split. There is our journal entry once again. Note that there's no impact on the income statement here. We purchased one asset and we purchased it with a liability. We hadn't earned any revenue. We haven't incurred any expense. We will incur an expense as we allocate the cost of this furniture, not in accordance with when we pay for it with cash, but in accordance with when we consume this furniture in the format of depreciation. We'll see that in the adjusting journal entry process. $75,000